Investors in India, they buy return and not risk.
One common perception is that derivatives are risky instruments.
Suppose if it's a pure long short equity fund,
Investors will be spoiled for choice. For a conservative product within SIFs, I don't think why it cannot be a large part of a client's portfolio.
how is the debt SIF is going to be very different from a debt mutual fund?
Today, the big challenge there is that what do you short?
Parameters they should look at before investing in any SIF investment.
The category itself, right? Because category will help calibrate your risk-reward characteristics to some extent.
How do you think is going to be strategy for the beta of the fund?
Today, when you look at a mutual fund product, it's largely beta with some degree of alpha.
Welcome to Fincast, our podcast show. Episode 4, where we understand a very new age of investment, which is specialized investment fund. We like to dig deep into what SIF is all about, what are the risks associated, and you know more on the virtues of investing in SIF and including a part of your overall portfolio. For that, we are very happy to welcome Mr. Gaurav Mehta, who's from SBI Mutual Fund. He's heading the equity SIF business out there. Gaurav, after completing his BTech in chemical engineering from IIT Bombay, did his post graduation from IIM Lucknow, and he is a US CFA charter holder. He spent about almost 20 years managing equity mutual funds business, and he is now here to help us demystify all about SIF. Hi Gaurav, welcome to Fincast.
Thank you, Tanvi, and thanks for inviting me.
Ways of investing in the market. In fact, it is told that it's an amalgamation of PMS, AIF, and mutual fund as a category. Okay, they've called specialized investment fund. Okay, so for a normal layman, Gaurav, I would like you to first clarify what exactly is SIF. How is it different from a regular mutual fund?
So I think you're right. Specialized investment funds is the regulators' attempt to bridge the gap between a mutual fund and conventional alternatives like PMS and AIF, and you can look at it in different ways. First, the minimum ticket size requirement here is 10 lakhs to begin with for the SIFs offered by a particular AMC, which is much lower than the 50 lakh and 1 crore requirement for PMS and AIF respectively. But versus a conventional mutual fund, it's obviously a bit higher. But the advantage versus a conventional mutual fund is that the regulator has allowed more flexibility in the usage of derivatives. So, for example, today mutual funds cannot go short something that they don't own. Shorting is essentially selling something in anticipation of that stock falling and benefiting from that price fall. So, most conventional mutual funds are structured as long only instruments. They own securities. If prices go up, they benefit, but there's no way to benefit from decline in prices. In SIFs, you can go up to 25% unhedged short. That means you can go short futures of stocks that you don't own if your view is that prices will decline. So I think that's something, usage of futures to or derivatives to an extent that is not allowed in mutual funds. Even for options, there is a lot more flexibility on what you can do in SIFs versus what you can do in conventional mutual funds. So if you think of it, this is a structure that allows more flexibility on the usage of derivatives. You can benefit from price declines as well. In general, structure trades around options which help you achieve a desired risk return objective, things that you could not do in conventional mutual fund. But all the positives of a mutual fund apply, which is that it is a regulated product, very transparent, liquid, and from a taxation point of view also it's similar to a mutual fund, which is that if it is structured like a equity tax product, then you pay equity taxation on redemption of the fund, which is 20% and 12.5% for short term and long term respectively. And if it's structured like a debt product, you pay debt taxation. We all know that tax structures in, let's say, PMSs and AIFs conventionally have been a little more, there's a transaction level tax and whatnot. So to that extent, I think, this is a good in between where ticket sizes are limited versus PMS and AIF. Tax treatment is better versus PMS and AIF, but there is more flexibility around the kind of strategies and the kind of risk return objectives that you can achieve versus a conventional mutual fund. So yeah, I mean, an exciting journey, and hopefully, people will innovate a lot across these strategies, and investors hopefully should be spoiled for choice.
So before I ask more risk related question, can you also elaborate what are the three broad categories and the subcategories that SEBI has permitted, allowed mutual fund asset management company to actually curate those kind of product?
Right. So the regulator has said that you can have a total of 7 categories of SIFs, 3 equity, 2 debt, and then 2 hybrid.
Correct.
Now within equity, there are the 3 categories are: one is an equity long short SIF, right, where you are unconstrained on market cap, on sectors, you can do whatever.
It's kind of a flexi cap.
Yeah, it's kind of a flexi cap. All you have to make sure is that you those same restrictions around 25% being the maximum managed shorts, etc. apply, but beyond that there is no further restriction. There is a second category within equity which is X top 100 long short.
Correct.
And there the regulator is saying that a predominant portion of your portfolio should be in stocks outside of the top 100. So in a way, this is a product which is largely catering to mid caps and to some extent lower market capitalizations than that. So to that extent, there is a bit of a market cap differentiation here. That apart, you can be unconstrained across sectors and so on. Then there is a third category within equity which is called sector long short. Now, sector long short is where you have to take active calls on sectors, and I think a total of four
Four
sectors
sectors.
at maximum is allowed in that fund. So let's say you can, for example, have a situation where you're long 3 sectors, where you're thinking that 3 sectors should do well, and you're short 1 sector, where you're thinking that 1 sector will not do well, and hence you benefit from the sector underperforming or declining. Now, this is an interesting strategy because you'll have to have very strong sectoral views because, on one hand, you can get your long right and short right as well and make a lot of money. But the risk is that you can, as an active manager, you can get both of them wrong. So to that extent, this is a slightly more aggressive proposition, but an interesting way to sort of crystallize your sector thoughts in a very sharp manner. So I think those are the 3 categories within equities: an unconstrained long short, X top 100 long short, and sector long short. Similarly, there are 2 categories within debt. One is an unconstrained sort of just a debt long short category, and then the other one is sector long short within debt. So those are the 2 debt categories, and there are 2 hybrid categories. One is a hybrid long short and an active asset allocator long short. In an active asset allocation long short, you have a wider choice of asset classes to operate in. For example, commodities, etc. is something that you can do there. In the hybrid long short, you have largely equity and debt to work with minimum 25% investments in each of these two. So those 7, 3 equity, 2 debt, and 2 hybrid is the number of a total of 7 categories that the regulator has allowed at the moment, and an AMC can launch 1 fund within each of these categories and not more. So I think that's the bouquet of SIs that are available.
I assume that the minimum investment of 10 lakh stands per PAN per company. Is that correct?
Yes. So, for example, if an AMC launches 2 SIF strategies, an investor can theoretically start the journey with 5 lakh in each of those 2. On the other hand, if we start with 1 SIF as an AMC, then the investor will have to start the journey in that single SIF with 10 lakhs. So in a way, this is like saying that within the AMC and its SIF offerings, you have to, as an investor, maintain 10 lakhs at all points in time.
That is per AMC limit.
Per AMC.
So if I have 3-4 mutual fund houses, and as an individual person, I can have 10 lakh in each of them.
You will have to have minimum 10 lakhs in each of them. Obviously, there's no upper limit to it. But you can't club all 4 and say that I only want to begin my SIF journey with 10 lakhs across these 4 houses. Individual fund house level, you have to maintain 10, which can be in a single strategy of that fund house or in multiple SIF strategies of that.
But there's also a introduction of accredited investor out here. If I'm an accredited investor, then I guess my minimum limit does not stand at 10 lakh.
Yeah, I think if you're an accredited investor, I think there is, as far as I know, there isn't a
1 lakh
requirement of that sort. Yeah, so
1 lakh I can start with.
I don't know if 1 lakh is also a limit or not, but yeah, I think you can start at a much lower number than 10.
So now, I mean, Gaurav, you've touched a very important point out here. See, most investors in India, they buy return and not risk. Okay. And by virtue of introducing this kind of a product, SEBI has given a lot of flexibility in the hand of a fund manager. Okay. Now, with that flexibility comes an additional degree of risk.
Mm.
Okay. So, one, while evaluating a fund, how should an investor evaluate an SIF, say, equity fund category within a like? Suppose you are looking at a long short equity category, how should an investor evaluate a fund? Should it be looking only on the basis of return, and what are the other parameters one should be evaluating?
Right. So I think, very interesting question, Tanvir, because one common perception is that derivatives are risky instruments.
Hmm.
And if SIFs are allowed more flexibility on derivatives, then this is a short way of generating higher returns. I think that's not true, because derivatives can be used to increase risk. They can also be used to mitigate risk. And depending on how that product is structured, it can be, whether it's using derivatives to increase risk or to decrease it. It can be an aggressive product or a conservative product. And which is why the real sort of appeal of using derivatives in SIFs is to be able to create varying degrees of risk reward propositions.
Hmm.
Now, how do you evaluate how a product is structured? Obviously, you'll have to go through the product documents, and it should detail, or it should give you some insight on, what is the risk return objective that is trying to achieve, whether it's aggressive or conservative. Uh, and very simply put, you should just look at the benchmark that the fund has chosen, right? Because the benchmark should do some justice to what the risk reward sort of outcome or intended risk reward outcome of that strategy is. And you're also right in saying that within the same category of SIFs, people can approach, or different AMCs can approach very differently and create, within the same category, create a very aggressive proposition versus a very conservative proposition. So I think, which is why the regulator has put in that 10 lakh minimum, that, they want investors to take informed decisions when choosing these products. But I think going through product documents, going through benchmark, I think those are some basic checks that an investor needs to do. Take into account what the risk reward objective of the strategy is. But just to reiterate, don't think of SIFs as only aggressive products. You will see a wide spectrum of risk reward positioning through a mix of different SIF categories, which all AMCs will try and address.
This is what makes comparing more difficult, isn't it? In fact, now assume I have a one asset management company which is running a very aggressive stance of completely running a leveraged portfolio, and other is running a portfolio which is like hedged with bare minimum equity. So you are operating in two different spectrum of risk, and in that category, if I have to compare return, obviously the fund that is taking less risk, the return may not be commensurate, right? And if I, as an investor, only look at return, then I was picking always a higher risk category of fund. So then comparing becomes even more difficult, despite having a benchmark.
So I think the first thing which the regulator has very clearly said is that you're not allowed to take any leverage here. So, for example, if 100 rupees is my AUM, even if I were to go 25 unhedged short, which is the maximum that's allowed, I'll only be left with 75 rupees to take the remaining exposure through long or other strategies. So to that extent, I think that's a standard thing across SIs, that you will see that you can't leverage too much,
So
because
you're saying the
leverage is
net
not allowed.
position has to be in 100.
Yes, the equity exposure has to remain, or the whatever is the asset class exposure has to remain within 100. And they're very clearly defined sort of exposure norms around what counts as exposure and what doesn't. And all of that put together, you cannot exceed 100. So to that extent, high degree of leverage will not be possible in a product like this. But even without that, you're right that you can have you can use the derivatives to take active calls, or you can use derivatives to hedge out your current active calls and mitigate the risk reward proposition. So to that extent, I think you're right that different AMCs within the same category can create very different very differently placed risk reward products. And my sort of limited point here is that I think an AMC should do justice to the strategy by choosing the right benchmark, and clearly articulating the strategy in its product documents. So I think, if you go through those, you should broadly be all right in terms of what the intended risk reward objective of that strategy is. But again, just to sort of go back to my first point, which is that that's why there's this 10 lakhs limit, that this is something where you need a more informed investor base, and hopefully more informed advisors to guide these investors towards the right product.
So I think this SIF is a new category, and the awareness will gradually build up. But for the sake of my audience and simplicity, can you explain? Suppose if it's a pure long short equity fund, what is the maximum risk exposure it can build? How the portfolio construct will look like, and vis-a-vis a portfolio construct which is actually hedging risk and running a low risk portfolio, how will that two differentiate and look like?
The regulation says that you can go up to 25% unhedged shorts.
Correct.
Someone may run a long only portfolio with, let's say, 90% long exposure and only 10% unhedged shorts. And those unhedged shorts can also be opportunistic in nature. So then it can look very much like a long only portfolio. On the other hand, someone might say that, I want to use 75% long exposure and 25% short exposure at all points in time, so that on a net basis, my exposure is 50%, right? 75 long, 25 short. So I'm only 50% exposed to market direction. And on the remaining 50%, I'm trying to create a market independent return. So that's one way that people can structure it, which is very different from a long only kind of an approach. A third way that people can sort of structure their portfolio is that against all the equity exposures that they buy, they may use options, for example, right call options against your existing exposure, buy protection on the way down against your existing exposure, in ways that the current mutual fund construct doesn't allow you to do, but SIFs can, and run an even more conservative product with the net equity exposure being even lower than 50%. So, these are just some of the ways I want to keep it simple, where you can within the same category have a very 100% equity like product, 50% equity like product, or a much lower equity allocation product through the use of options. So you're right. I mean, people will innovate around this, and as I said earlier, investors will be spoiled for choice. But to your previous question, I think an informed assessment of the product risk return objective will be important.
In a short, comparing will become very difficult, because let me put differently. Suppose I have like taking your example, I have a 90% long and 10% short. Okay. On the other hand, I've got 50% long and 25% short. So this gives me an idea. Okay, so this portfolio is less risky on a theoretical basis. Okay. But what happens if, for example, the long works out in favor, okay, and the short doesn't work? Okay. So my risky portfolio may be delivering my much higher return, and this will not deliver return.
So I was only talking about the market direction linkage. So when you're 75 long and 25 short, your market direction linkage is 50. But does that necessarily have to be a low risk portfolio? Absolutely not. And you, I think, hit the nail on its head. What can you're talking about the fact that the 25 long works out and 25 short doesn't work out. You can have a situation where it's exactly the opposite, right? So, for example, you bought some FMCG stocks on the long side, and you've gone short some other FMCG stocks on the short side, thinking that you're just playing on the relative performance, and you can get both legs wrong. Your longs can underperform your shorts, so you can lose money on shorts and you can lose money on longs. Or let's say from a sector standpoint, you're 25% long on FMCG and 25% short on auto, and both of them can backfire, right? FMCG can come down, auto can move up. So to that extent, yes, from a pure market direction exposure point of view, you are mitigating that market direction exposure, but you're still creating some idiosyncratic risks by doing this. So to that extent, this isn't a less risky proposition by any means. And which is why, when you're evaluating products, one thing is to say that, everything will have a very different positioning. But you have to think of two things. In the absence of anything else, what is the risk adjusted return that the strategy delivers? So that would be one standardized way of comparing products. And second would be to say that, in my portfolio, where are the gaps? Do I need an aggressive product? Do I need a conservative product? Do I need somewhere in between? Am I looking for stability? Am I looking for taxation? Am I looking for returns? And then that trinity is something that you optimize basis what the product features are.
Fantastic way. But this was my next question. So, as an investor, when I'm evaluating a particular fund, what are the risk ratios that I should be looking at? Should I be looking at Sharpe or information ratio or beta? Which should I be looking at for a fair evaluation of different category, different fund within the same category?
So I think all of those sort of ratios have their own pros and cons. But again, I think it boils down to what your eventual objective is. For a very long-term investor, the intermittent volatility may not be something that really matters, right? So for them, end-on-end returns might be the only measure that they want to look at without thinking of anything which bring any risk measure that looks at intermittent volatility. Some others are more worried about the participation that the fund delivers in a down market. So they're okay to lose some upsides in a rising market. So if the upside participation is not great, but the downside participation is extremely small, they're happy, right? That this is at least something which is market unlinked. Because yes, on upsides I don't make as much money as the market, but on the way down for sure I don't lose as much money as the market. So that can be one way, upside participation, downside participation, or the overall correlation to market returns can also be one measure for people to measure performance. And and a very simple measure could be that, okay, this is my investment time frame, this is my return objective. What are the chances that the variability in returns over a 2-year time frame will be very low around that targeted return? If with that time frame in mind and with that return objective in mind, I can be to some degree of certainty, with a high degree of probability, I can say that it will be in the ballpark of that return number with low variability around it. Then also, I think that I'm happy with a product like this. So I think it depends on the and for some other investors, every bout of volatility matters, right? So for them, even monthly drawdowns may be one factor that they want to consider. So I think there are various ways, but a combination of these, depending on your objectives, should help you choose the right product.
So, will it be fair? Because see, currently what we do, we only introduce PMS to a client portfolio where the minimum investment is about 2.5 crore, because we feel any fund manager we should not expose more than 20%. Because see, as fund manager, you don't come every day to say I can make a blunder, but there is uh, a chance of error of commission or error of omission. You've not picked up a sector, okay, you've not done anything wrong, but maybe you've missed a sector and you've underperformed. So there, keeping that philosophy in mind, we allocate only PMS to those portfolio where we have more than 2.5 crore, and AIF to portfolio where we have by 5-6 crores and above, okay.
Right.
So keeping SIF from that same perspective, do you think this can be part of a tactical asset allocation part of it, or should it be part of a strategic asset allocation?
So I think again it depends on how the portfolio is positioned, right? For a conservative product within SIFs, I don't think why it cannot be a large part of a client's portfolio. For example, think of a product which is trying to give you low variability, maybe not very aggressive returns, somewhere closer to moderate returns. Let's say the premise is inflation beating returns over a 2 to 3 year time frame with lower degree of variability. Now, a product like this will have some appeal for all portfolios. Now, for the more conservative investors, this may be the thing that they want, right? So this can be a decent allocation in their portfolio. For a more aggressive investor who are very growth and return oriented, maybe this allocation will be slightly lower, but this may find space in all their portfolios. But again, if you are thinking of an aggressive product, maybe that allocation will move more towards satellite allocation. But if you're thinking of it as a conservative product, depending on what kind of an investor you are, it can be a satellite allocation, or it can be a core allocation as well.
Gaurav, can you help me compare? So within the equity category of SIF, we have three choices, right? The long short, which is more like a flexi cap. Next, beyond X100, top
X top
100
100,
is
yeah.
more like a mid and small cap category. And then you have the sectoral fund, so which more like a sectoral theme. So if you have to compare each category with a already product available in a mutual fund basket, how would you like to compare each of them?
So just from a market cap standpoint, while as you rightly said, right? I mean, the equity long short category is something which is more of a flexi cap kind of an approach, while the X top 100 category, in my sense, will look more like a again, it depends on how you structure it, but it can look like a large and mid, it can look like a mid cap, or it can look like a multi cap,
Hmm.
right? So it can be one of those three, or maybe mid and small cap also, from a market cap positioning point of view. So to that extent, from a risk return point of view, you would think that X top 100 uh, um, is more likely to be a more aggressive product than the unconstrained equity long short. And similarly, when you think of the sector long short, this is likely to be somewhere in the vicinity of your business cycle funds or sector allocation funds on the long only side, with the limited caveat that when you're buying a basket of a few sectors, and especially when there is no restriction for you to be only on four sectors, I think, which is the case today in business cycle funds or sector allocation funds on the mutual fund side, then you can diversify a bit too much, and uh, try and move closer to hugging the benchmark without necessarily taking very active bets. But when you think of a sector long short strategy with you only allowed to operate in four sectors, then whether it's on the long side or on the short side, your individual sector calls becomes that much more important. So I think your skill in calling out sector rotations will be tested much more here than it is in a conventional business cycle or sector allocation fund.
Hmm. So similarly, in hybrid and debt category, can you help me compare with the available funds in the mutual fund space?
So, I'm not the best expert on the debt category of funds, but at that, I think today there's a bit of a challenger with respect to getting exchange traded instruments to express short exposure. But I think the two categories there are is a normal long short and a sector long short. So I think a normal long short will compete with a conventional, it can be any fixed income product for the matter. And just like I explained for equity sector long shot, I think the same risk reward works there, that you have to be extremely sharp when you are sort of doing it. Um on on the two hybrid categories, uh, I think the hybrid long shot category will compete somewhat with the
Aggressive hybrid?
conservative.
Conservative.
Again, it depends on how you are
Ah,
structuring it,
ah.
but it can be conservative to moderate risk. A few people may decide to even make it that high risk, but when you have three categories to available in equity side, and usually for an investor, the perception when they think of hybrids is that it is a bit conservative, and then hybrid with the flexibility to go short and use options and so on. I would think that most people would want to keep it as conservative, but never say never. So I think this will then, in my worldview, this will compete with, or at least this from a risk reward positioning point of view, this will be the direct comparable on the mutual fund side would be conservative hybrid or equity savings, or for that matter, even to some extent the
BAF kind of.
balance advantage kind
Ah.
of a product. Um, there is the second category in hybrids is active
Asset allocator.
asset allocator long short. I think that's something that I don't think there is any comparable on the mutual fund side today, because it allows you significant flexibility in the usage of different asset classes,
How is it
including
different from
commodities.
BAF?
The direct comparison here would be MAF, because in multi-asset you're allowed to do commodities.
Correct.
In BAF you're not. So to that extent, because you're allowed to do commodities here, it will be similar to multi-asset. But in the current multi-asset funds usually have not taken extremely high uh, commodity exposures. Plus, obviously, they don't have the flexibility to go short and so on. So I think again, just as I was explaining for the sector long short category, your views on different asset classes, getting the long of it right and the short of it right, I think that will be tested a bit more here than in the conventional multi-asset funds. So it's something similar, but with a degree of sharper focus, which also means higher risk, which also means your ability to get those calls right is much more tested here than it.
Yeah, in fact, in a normal mutual fund, you find a lot of the fund within the same category. It's more like benchmark hugging or peer hugging. Okay, you're very close to that. But here, it'll be a test of true fund manager's capability, where if you are not following the herd, you will either stand out significantly or you will look like a bad boy. In fact, what happened in flexi cap category in one of the fund, where the fund manager took exposure, especially Parag Pare, we took exposure of a very large cash call and worked in his favor. Okay, that worked. If it didn't work, it would have looked like completely the opposite side. Okay, so same thing will, do you think will happen here?
No, I think you hit the nail on its head, right? I mean, which is that when you're taking active long calls and active short calls, you can get both of them right, you can get both of them wrong. If you get both of them right, then obviously you look like a hero. If you get both of them wrong, then you look like a loser. So to that extent, you're right that the sharpness required or the test of fund manager skills or their frameworks will be much more at work here, and hopefully from an investor's point of view, that's a positive, because uh, if you're paying a fee, you get that sort of sharpness in your portfolio construction.
I know you are not managing the debt side, but just for a basic understanding, how is the debt SIF is going to be very different from a debt mutual fund, and what kind of flexibility a fund manager has here?
So I think today the big challenge there is that what do you short? Because on the debt side, exchange traded instruments where you can express a short view are very limited, or close to non-existent. While you have a very vibrant futures and options market on equities, you don't have something similar on the debt side. So I think that's
So will the
something
use of IRS, interest rate swap, and all will come into play? Do you think
our
this will deepen the bond market?
yeah, but our understanding, and I think this is something where the industry is seeking more clarity from the regulator, is that even OIS may not be something that is currently permitted. You're talking about IRS or OIS?
Oh yes, and IRS both.
Both of them. So I think the liquidity, I mean, OIS in any case is not an exchange traded instrument. So I think that piece is still a work in progress at this point in time. But when you think of the sector debt long short, I think there you can take concentrated sector exposures. But again, if it's only on the long side, then that you can do even in a credit fund today for that matter, right? So I think getting that ability to short is something that is still work in progress on the debt side.
How do you think is going to be the strategy for the beta of the fund?
For the beta of the fund, I mean, you may not have a beta strategy altogether. I think the intent of using that short exposure and derivatives differently is to, or more flexibility than mutual funds, is to reduce the overall beta, right? Because today when you look at a mutual fund product, it's largely beta with
Ah.
some degree of alpha,
Hmm.
right? If overall markets do well, a long only product does well. If markets fall, a long only product falls.
Hmm.
The fact that you can use derivatives and you can hedge your risks, you can express a short view on things that you don't own. I think all of those things should overall look to reduce the beta of the portfolio. That said, for example, you can buy a lot of call options and still add some beta to the overall portfolio. But I think in general, the intent will be to create returns with lesser reliance on overall market beta.
So in that case, how will the strategy delivered alpha compared to say a normal mutual fund?
Let's say there are two metal companies, and you're positive on one and negative on the other. And so you buy one to benefit from its stock price increasing because that's your view, and you short the other to bet on a decline in stock prices because that's your view. Now, if this trade works in your favor, which is that stock A goes up, stock B goes down, uh, then obviously you make money on both sides. But overall, in this trade, your intent is for A to outperform B, and you would have made money. Then, because these two are metal companies, your reliance on metal index doing well or not reduces. Versus which, if you think of if a long only fund where you either own stock A or stock B, both of which are metal companies, you want metals in general to do well for these two to do well. So that's the beta element. Obviously, there's alpha. You can have some metal companies outperform the overall metal index. Some companies will underperform. So even in a long only construct, you have the role of alpha. But in this case, your ability to create returns which are betting on individual stock performances increases much more than just relying on the underlying index to do well. And which is what I meant by when I said that your ability to create returns which are less reliant on beta increases.
Until now, see, most of the equity fund in India or that way is mainly been long only. So it's more fundamental driven. Do you think that the use of data analytics or a technical analysis here will rapidly go up? Because there, when you are trying to short something, you may not want to have a fundamental view, or
Hmm.
you have a very short term tactical view on that stock.
So, just as I said that there is a common belief that derivatives only increase risk,
Hmm.
which is not the case. They can be used to mitigate risk as well. Similarly, I think there is also a common belief that derivatives are only, to express trading views or technical views or momentum views and so on. I don't necessarily agree to that. Yes, obviously, that's one way to use derivatives, but you can also use derivatives to express a fundamental view. Today, for example, whenever money comes in a fund, it goes on to buy assets. And if there's a lot of inflow, it can lead to some overvaluation in different pockets of the market, depending on where money is going. And unfortunately, in the conventional long only mutual fund construct, there is no way to express a counter view on this overvaluation. You can choose to ignore these stocks and not buy something else, but there's no way to bet on this overvaluation correcting itself, or for that matter, a fundamental deterioration correcting itself. You own the stock, or there's no way to bet on a fundamental deterioration, right? You can own the stock and sell it if you own it, but if you don't own it, you just see, right? I mean, there's no way you benefit from taking a view on a fundamental deterioration or on an overvaluation correcting itself. But in an SIF, you can do that, right? Because if you short something where you think that fundamentals are deteriorating or valuations are expensive, or maybe a combination of both, and hence you think that stock prices should decline, so you short that without even owning it, and then if the stock price declines and your view is right, you benefit. So to that extent, fundamentals will also play a very important role. But you're right that risk management is also very important, because when you buy something, it maybe declines 20-30%. When you short something, it can rise 30-40-50% in no time, right? So to that extent, you also want to keep some of those tactical indicators in mind, whether it's a bit of technical, whether it's near-term fundamental catalysts, and in general, a strong risk management framework around whatever you're doing. But I think fundamentals will continue to have a very important role here as well.
Do you think that given this kind of a flexibility, will it increase the market volatility? For example, today, if I have a stock which I know fundamentally it's very overvalued, uh, under the long only strategy, I may not buy.
Hmm.
But if I have a option to short, I may short that.
Right.
Correct. So, do you think that will increase the volatility in the market?
Don't necessarily agree, because when you're allowed to only take one side of a trade, then the counteracting forces don't exist. So for example, if you can only buy, the stock will keep going up, and at some point, obviously, that bubble will burst, and everyone who's holding the stock at that burst point will obviously suffer. But when you have counteracting forces, maybe at all points the stock sees some sanity check, right? Because there are people on the other side expressing a different view, and if anything, maybe for all that can reduce this boom and burst cycle or the amplitude of it. and hence overall lead to a reduction in volatility. Now, I'm not saying that will work in all the cases, but all I'm saying is that there is a counter view to this volatility argument as well, and which is why I think, and I can't be in the regulator's mind, but I think at some point this is a thought that would have gone into their minds as well, that today all the flow is going into long only funds, because you only have long only mutual funds at this point, and hence it's only leading to one way mispricing in the market. Can you have something which acts as a counter force and helps correct this mispricing and hence reduce the volatility that mispricing create eventually?
So, Gaurav, because as a consumer, when I look at SIF, uh, what do you think are the strong capabilities the fund house must build to successfully navigate this SIF journey?
So I think the basics remain the same, which is that you have to have a strong research backing, because research is the fodder for ideation, whether it's on the long side or on the short side. You also need very strong and robust risk and compliance frameworks. It's true in the mutual fund construct as is, and in the SIF world, it becomes all the more important because of usage of derivatives and so on. And thirdly, you need the ability to deal with derivatives, understanding of options, how do payoffs evolve under what situations, what are the stress tests, how do sort of, for example, margin requirements work, um, how much buffer do you need for MTM management, the liquidity profile of these derivatives, and when that liquidity rise down, how do you manage your risks? So I think um, that degree of understanding of derivatives is important, but I think the basics stay the same, which is you need a strong research support, you need a very strong risk and compliance framework.
So now, from an investor perspective, a client perspective, what are the few important parameters they should look at before investing in any SIF investment?
No, I think one is the category itself, right? Because the category will help calibrate your risk reward characteristics to some extent. B, again, as I said earlier, the benchmark, because that again helps you understand the risk reward proposition of the fund. And third, you should go through the product documents to get some sense of how it fits in your overall uh, portfolio allocation, because there is no one size fits all ever, right? So it has to fit in with your risk reward proposition, your time frame, your objectives, and so on. And a related aspect to that is to keep liquidity profile in mind, right? Because SIF regulations allow fund houses to alter the liquidity, the subscription and redemption windows, etc. for that matter. So I think that is again an important consideration that should go into deciding your overall sort of allocation. And a related, you know, thing that you usually do with any of your investments, I think this is something that investors think the first, is obviously the associated taxation of the product at hand. So I think there are several of these parameters that go into, in general, go into deciding what a suitable product for you is. But I think the crux of it is that you have to think of where it fits in your overall portfolio allocation, and a product is in itself no good till it meets or it fulfills a particular objective within your overall portfolio composition.
What will be your recommendation to an investor while investing in equities, SIF, hybrid and debt SIF? What should be the minimum time horizon of investment to ensure that they reap the benefit? Because see, in shorter cycle, a fund management can go right and wrong both ways. Okay, but over a long term period, the probability of getting more rights than wrong, I am assuming that will happen.
Yes.
So, what is the minimum time horizon of investment for equity, hybrid, and debt would you recommend?
So again, I don't think there is a general rule to this, but in general, you're right that if it's equity oriented, it has to be a higher time frame. For debt and hybrids, depending on what the structure of the product is, you can have something which is, which works even for shorter time frames. So, for example, in the SIF, in the hybrid long short category, you can have a mix of debt and equity in a fashion that you're still creating a conservative positioning with lower variability of returns and still trying to beat inflation. And in that context, maybe a time frame of 2 to 3 years may also suffice, which for equities usually tends to be 5 to 7 years. So I think it depends on the product construct, but I think you have to weigh two things: a, what is the intended time frame of the product, and b, assuming I don't have to live through that entire time frame, what are the exit mechanisms for me? Is there enough liquidity, from a subscription window or a redemption window point of view specifically? Is the tax still favorable if I have to redeem early? Um, uh, and those are the few, are there exit loads, etc. So those are the few things that go into. So I would ideally want a product that I want to sit in for, to be with for the long run, but I should have enough flexibility to exit if circumstances change.
So the final question I will ask. So, as an investor or consumer, when an advisor is positioning me SIF as a consumer, what are the most relevant question I should ask my advisor to explain before I invest in SIF?
No, I think first and foremost thing is that how are they going to use derivatives? Is it to increase risk, reduce risk? If reduce risk, is it just reducing market linked beta, or is it actually reducing risk? Because I think in a previous example, I did talk about how going long on one security and short on another security can actually still increase risk, because
Correct.
both those calls have to go long. It just reduces market risk, but still there is risk, right? So is it actual risk mitigation, or is just, what kind of risk are you sort of trying to address through the use of derivatives? And then as a consequence of these two, what is the risk reward positioning of this product? And hence the final question that you have to ask, and I've sort of said it multiple times, at the sort of risk of repetition, is that where in my overall where in the overall risk reward spectrum, and specifically in my portfolio, does this product fit? What is it that fulfills that the rest of my portfolio is not able to fulfill?
Address it. Okay,
Yes.
very good. Thank you, Gaurav, so much for helping our audience understand more about SIF. Thank you, everyone, for watching the episode. Keep watching our show. We'll come with more and beautiful insight on finances.